Tom Schrandt, welcome to the Fiduciary U podcast.
Thank you very much, Josh. Great to be here.
I'm excited to have you. You and I have a long-standing relationship going back, it's probably 12 or 13 or 14 years. I got connected with you, I want to say at an FI 360 conference around
I think it was.
around 2008. And I sat in a session that you did on E&O insurance for RIAs, and subsequent to that wound up hiring you for my firm, and you did a great job over the years. And you know, fiduciary liability insurance and E&O insurance is a hot topic right now because the dynamics of the market have changed so much. And so I think this is a really timely discussion, and I think especially advisors are going to get a lot out of this conversation today. So I'm really excited to get into it.
Definitely agree. There is certainly a lot going on right now.
Indeed. And there's articles. I think 401k specialist and plan advisor, a couple of months ago had articles about just how the fiduciary liability insurance market is changing, and we'll get into this. I actually was consulting to a large $2.5 billion plan in the fall around doing some strategic planning for them. Not as their advisor, but some more kind of one-off consulting. And they had run into a major issue in their renewal. So we'll talk a little bit about that. But, for listeners that may not be aware of you or Lockton Affinity and what you do, why don't you give a little bit of background about you and about your team and the space that you specialize in?
Okay, sounds great. Yeah, so I'm a partner with Lockton Affinity, which is it's the group insurance program division of Lockton Companies. So Lockton Companies is the 8th largest independently owned, privately owned insurance brokerage firm in the world. Within my group within Lockton Affinity, I head up our specialty lines programs, which encompasses our financial institutions division. So we manage, we're the national plan administrator for Lloyd's of London. We developed this investment advisor, E&O, and plan advisor specific policy form that we distribute on behalf of London to fee-only independent advisors. We have cyber liability, counterpart type products that complement the E&O. And then, of course, we always help our plan advisors help their plan sponsor clients with first-party fiduciary liability insurance. So at the hub, we're a specialty firm, basically, in the financial services industry.
Got it. And I think there's some good conversations that we can have, and maybe even as we get in, kind of defining the difference between you. It's funny. I one of the things I remember from that session years and years ago was you talked about for RIAs the importance of, I believe you called it like ERISA, like affirmative coverage or something along those lines.
Yep.
That specifically kind of carves out and addresses RIAs that work with ERISA plans. You talked about just a moment ago with plan sponsors that they have first person liability coverage. So maybe talk for a minute, like what's the difference between the two of those?
Yeah, that's a really good starting point. So first party versus third party. Fiduciary liability insurance, exposure anyway, exists at the plan level and at the service provider level, obviously. So that's sort of the line in the sand that divides those two products. So an E&O product is designed to cover the professional services that a professional renders to a paying client. The client pays for that service, in this case, investment advice. If the client alleges that they're damaged as a result of that, that's the trigger for an E&O claim. And that's third-party fiduciary liability for an investment advisor, a third-party administrator, a record keeper. The client in a plan setting, the plan sponsor, they have a first-party exposure, meaning their exposure to do the right things for the employee benefit plan for their participants. So that's an isolated exposure versus a services exposure on the third party E&O side.
Got it.
That makes sense?
No, absolutely. And so talk a little bit about how the kind of the market, how the market is evolving. I mean, I know historically And so I think what we can talk about is like what relates to RIAs, because obviously E&O wise that's kind of changing, and then for plan sponsors, it's getting a lot harder for plan sponsors to get coverage. I mean, I think in the past, a lot of fiduciary liability coverage is maybe like a rider on a general policy was kind of like throw-in coverage. Pretty much any general P&C agent could just kind of check the box, and carriers would throw that in for, quite frankly, not it was pretty inexpensive coverage for companies and for plan sponsors. But obviously, with the just explosion of ERISA litigation over the past 10 to 15 years, that market is really changing. This large plan I consulted to, that was interesting. It was about a $2.5 billion plan, and they were having trouble accessing the insurance market. They had a renewal coming up, and the carrier kind of threw at them like a $10 million deductible for their plan, which was absolutely kind of untenable. And they had been working, I think, with just kind of a general broker that really didn't specialize like someone like you in the market. And really, there was not a whole lot to do for them. So maybe talk about the evolution of fiduciary liability coverage over the past 10, 12, 15 years, and where we find ourselves now in the market.
Yeah, no, that's a really good question. I mean, so I'll start backwards. Right now, where we stand in the market, we're in crisis, from a fiduciary liability capacity perspective. So back in the day, as you pointed out, fiduciary liability at the first party level, plan sponsor is typically packaged from the carrier offering perspective in like a management liability suite of product offerings. So that includes like directors and officers liability insurance, employment practice liability insurance, the fiduciary liability insurance, and maybe some crime like bonding. That's like a typical wrap type management liability intended to cover the exposures of a company offering plans and things of that nature, managing employees. So the fiduciary, as you spot on pointed out, was the lowest price point of that package back historically anyway. So it always ended up being a throw-in, for hundreds of dollars into this management liability, where the underwriters were really concerned about underwriting the directors and officers exposure, or the employment practice liability type exposures to state jurisdictions and things of that nature. And they're like, oh yeah, and we'll offer fiduciary liability insurance for $1 million, and it's $300. But now, and that was always annoying, to me as a broker specializing in this space, working with the best, plan advisors in the country. You're an ex-client there, right? So there was always this interest from my client base that I was servicing from an E&O perspective, saying, hey, I want to help my plan sponsor clients get fiduciary liability insurance. I want to educate them on fiduciary. So through the years, I worked with a lot of advisors to do just that. I say annoying in the front end of that, because it never netted to any sales, to me as an insurance broker or our company and our division. We did a lot of educating. And as I reflect on it and I think back, I'm like, why would that be the case? Well, it was just easy to get, right? Like we just talked about, it was just thrown in. It's obviously important, a very critical coverage point. But when it's not hard to get and there's so much supply, anyone can do it. But now as these, the evolution is that these excessive fee claims have entered the landscape, and it's just took this very inexpensive product from an insurance carrier's perspective, like they're putting these crazy limits out there for hundreds of dollars. These excessive fee claims come in, and there's $1 billion or $1 million settlements, and these fiduciary carriers are sitting there with a couple $100 premium in their piggy bank, from the risk, and they're writing limit losses on their $100 premiums for fiduciary liability. So clearly the market has shifted. So fiduciary liability, certainly in the large plan world, has went from a throw-in coverage line and a standard management liability policy to an absolute carve-out, standalone need type product. And not only that, it's being completely scrutinized from an underwriting perspective. We're seeing carriers actually add supplemental questions to their applications specifically around fees and how do you, like the excessive fee conceptual exposures that they're just throwing in, the carriers these plan sponsors, and you could just see the result is a higher premium, a very high retention or deductible, as you just explained with your large client. They're at the point, it's a sustainability issue at the carrier level. They can't charge enough premium for the limits that they're putting out for what's going on in the world right now. Excessive fee claims is the succinct way to put it.
And what about of the marketplace? Are you finding carriers that are just basically kind of folding their tent up and saying, you know what, we're not even offering this coverage?
100%, 100%. It's a capacity issue now. It went from all the supply, who wants it, to nope, we don't want it. We want nothing to do with those $1 million claims. We've changed our underwriting appetite as the carrier. We no longer write fiduciary liability insurance, but we'll write employment practices. We'll write E&O. We'll write directors and officers. But no, thank you for that small, inexpensive piece, that is potentially a ticking bomb, for an underwriter.
And mainly just because they don't have they can't charge enough premium to underwrite. Obviously you want to charge, and you hope insurance carriers, I would say, probably hope that, they can charge premium and that there are no claims and that the premiums they collect are higher than the claims they have to pay out. But now they're just, that dynamic does not work.
Yeah, and only the larger it just in general, not just fiduciary insurance, but any insurance program management, it's a critical mass game. Really, you need enough in the pot or the coffins to handle any claim that might come in. So these smaller carriers that were just in it and we'll throw it in, they might have got hit or got scared with a potential claim, and that's when they folded up their tent and they're out. So you are seeing the main, the Chubbs, the Travelers, the Hartfords, mainstream type carriers out there still offering fiduciary insurance, but are they with a $10 million retention? Or it's just, it's an interesting space, that's for sure.
Yeah, it's interesting about the. And I don't know why we're getting a little bit of feedback there on. I think I don't. Can you hear that feedback on your end?
A little bit, yeah.
Okay. So sorry to listeners. You might have to struggle through it. You mentioned though the questions. I probably 2.5 years ago, my largest client was a $1 billion plan, and I get an email one day from the head of comp and benefits, and she says, "Hey, I'm attaching this questionnaire. We're going through our renewal for our fiduciary liability insurance, and we got this questionnaire, and can you help me fill it out?" And I said, "Yeah, no problem." And so I open up the attachment, and it's like an 8-page questionnaire that was totally dialed in. It was all about excessive fees. It was asking very, very knowledgeable questions around obviously what the process for fees were. So what from a benchmarking perspective, it was asking things like, how are fees negotiated? Are they per capita? Are they pro rata? Really focused on record keeping fees, especially. How are they, applied? Even specific questions around like, have you or any of your employees been contacted by the following law firms? And it was, Schlichter, Bogart, and Denton, and it was Capozzi Adler, and there were a couple of other ones there that obviously were kind of the big players in bringing these claims against large plan sponsors. And I don't know if that was a compliance issue back in the day or not really my problem anymore, but I basically filled out the questionnaire and kind of just provided the answers of like, this is the process we go through. We had just gone through a comprehensive record keeping RFP and benchmark. So the timing was actually really good because I could kind of highlight what we've done and we had negotiated a pretty significant amount of fee savings. And so I could kind of highlight that. And again, this was probably 2.5 years ago and all was well and good, but it was really interesting to me about this questionnaire. And clearly it was somebody, it was a carrier. For a moment, I wondered, I was like, I wonder if Tom wrote this.
I had nothing to do with that. No. Take the fifth.
But I did a quick little Google search, and sure enough, This questionnaire had been making the rounds with some large plan sponsors. Nevin Adams had written about it a few years ago, that this had been popping up. So clearly, that was probably, at least from my perspective, around the time that these carriers started to pop their head up a little bit and say, "Hey, we need to start thinking. We need to start thinking differently." What is the underwriting process? So now, and this is probably good for you business wise, right? When probably frustrating, right? That when anybody can offer it, and you don't really need to be a specialist in order to kind of access the market for plan sponsors. But since that world has changed now, what's the process you typically go through, or you take a plan sponsor through, in order to try to get them coverage and make them attractive to the marketplace?
Yeah, so from a plan sponsor perspective, I mean, you're right. You referenced that supplemental question. It's funny. That month, I probably got that email to me probably 7 times in 1 month when it first launched, from advisors, like things that folks that like yourself that got into that same situation from their clients. So I can almost pinpoint when it was launched, and I saw several carriers using the same form or similar questions and things of that nature. So you made me laugh, thinking from the past there. But just generally speaking, in underwriters, I mean, I view that as a good thing when they're asking questions from a carrier perspective, because as an underwriter, if they don't understand something, the answer is always no, no, or very expensive, or both maybe. So that the supplemental questions were healthy, and I was happy to see them. But what they ended up what they're doing is ending up, with netting out a lot of declines, from a application perspective. I mean, so the underwriters are asking the questions not just to know. It'd be nice to know. Obviously, the answers are impacting their decision, whether either to offer insurance, period, end the story, or how much to offer that insurance for. So, the question. So, what I do, to your point, as far as, or what we try to do for our clients, is be better than the average agent, be better than the generalist. That I get an application from my client, I send it to a carrier, I get a quote, I then deliver that quotation to my client. I did my job as an insurance broker. Great. It's not that simple in these tough markets. So an insurance application is going to ask a lot of questions. Now, even more questions, as we just talked about certain things like fees. But what we do, and I advise anybody from a brokerage perspective that's listening to this, that you need to provide these underwriters with more than what's on the application. The application's asking questions for very specific reasons. We try to highlight things that aren't on the application to put our applicant in a better position to get better terms, to try to answer the underwriter's questions before they ask them, or their concerns that they're not asking and they have them anyway. So things like highlighting if the plan sponsor works with us, like a fiduciary consultant professional that specializes in it. I'd say that's the cost of doing business today. Before it wasn't. I mean, for our industry, any significant plan that's not using a third-party consultant is really exposed. I mean, this is complicated. You could think you're doing the right things, but I mean, it's ever changing and moving. It's a moving target. So, I mean, just to insulate yourself from another professional's perspective, if you get caught into a claim, is part of your defense, right? In if you're ever brought to that suit. So long-winded answer to your question is the process is we need to do more as an insurance broker to highlight the goodness of our applicants to these underwriters, because it's not a supply-friendly environment. They're very stingy. They're very skeptical. They don't want to lose their job, the underwriters, if they write a policy and it turns out to be a limit loss. So it's a dicey proposition right now.
Right. And talk a little bit about, because you and I have had this conversation before. It sounds like these carriers don't really understand. They don't understand the market, and they don't understand kind of the real world, the market, and because this is an area where they're having trouble getting their head around. Like you said, the answer is either no, or the the limits and the coverage and the premiums are so, like you said, are they really like you can offer or quote the business, but in reality, it is so off the reservation that like nobody's gonna nobody's gonna like take you up.
Quoting it not to win the business. Please don't take this.
Exactly. So what are some of the challenges you're finding as you're talking to carriers? Like where are some of the kind of the hot buttons or the issues, maybe the landmines where like those conversations, what are they struggling to understand? You and I talked before we started recording, and I had told you about the episode I had with Jerry Schlichter last summer, and we talked a lot about the economics of ERISA litigation from a plaintiff's perspective. And he was saying that he thought that lawsuits were going to come down market further, but he felt like the $200 million kind of plan size was really the floor, just because of the economics. These cases are highly complex, they're highly involved, and they take a long time. ABB, as an example, one of the very first ERISA lawsuits, that was filed in 2006. It didn't finally get settled until 2019 because it went through a number of different appeals, and he had to carry that cost the entire time. And he's like, I think they took like something like $18 million is what they made from that, from that case. But he said, what people don't realize, he's like, I get criticized because of $18 million, but he's like, the attorneys for the defense during that 13-year period billed like $43 million to the plan sponsor in legal fees. And so because he thought the bar, just these cases, they are so involved, down market, the economics just don't make sense. And so you get a lot of advisors that are out there and kind of fearmonger, the threat of liability down market and not even like the under $10 million, but if you're under the $200 million threshold, the likelihood of getting involved in ERISA litigation, it's not impossible, but it's very, very, it's very improbable in most cases. And so like the carriers, they think that, if you're a $5 million plan or you're a 500 or a 5 billion, that the potential risk exposure is all the same. I mean, the reality is that's not, we've heard a lot about cases coming down market. They really have not in a meaningful way. What are some of the challenges carriers are having in kind of understanding that? Or are they just painting every plan and all ERISA, all fiduciary liability kind of first party coverage? Are they painting with a broad brush and just assessing it the same for everybody?
Yeah, good question. Unfortunately, they are painting it with a broad brush and just looking at the fiduciary liability. I know about these excessive fee claims. I want nothing to do with that, or I'll play, but I need X and big retention. So it's it's a conversation that my team's having daily with underwriters, trying to make that very logical point, because Jerry Schlichter is correct. I mean, these attorneys work on contingencies, right? And these suits take forever and they're expensive to administrate, as it goes. Now, they're easy in the respect of their cookie cutter. It's, the playbook's there, right? Oh, I have to do that. It's almost a cut and paste, probably exercise.
It is. I actually asked him about that because you had like people now that literally would just cut and paste like the arguments. He built the playbook over the years, and now like other firms are coming in and being like, oh, great, like literally word for word cut and pasting.
Yeah, like typos brought over
Exactly.
and whatnot. Yeah.
Exactly.
So that concept is real, from an underwriter's mindset. Like, okay, this is not hard for it to do. What they're missing, in my opinion, or our opinion, is the economic comment. Like, you're right. Like, we haven't seen any like excessive fee claims below. Yeah, I would think around that 200 million mark or so. It typically is a larger, plan thing, and obviously it's that, the damage is just multiplied faster, in that world, making it economically sound for this. But from the underwriter's perspective, it's frustrating because they're acknowledging the exposure, but they're not acknowledging the reality of what's going to happen, and they're taking like knee-jerk reactions of like, nope, we're not interested. We might have sent a fiduciary liability submission out in 2009 and got 13 carriers back with different proposals, all pretty much. We'll send them out to the same 13 carriers and maybe get 2 back with questions, not additional questions. Yeah. Maybe I'll offer a term with this. So it's it's night and day from where it was.
And what's interesting down market is, I would say that the risk down market plans, actually the greater risk, advisors in the industry, we want to talk about, fiduciary, the risk of fiduciary liability, fiduciary breaches. Down market plans, actually, that isn't a major risk, I don't think. The bigger risk are operational failures. Mm-hmm. And having to go through, epicers or do a voluntary correction program. And because the plan wasn't administered properly, maybe an employer had, they had a cohort of employees who met the eligibility requirements, but for whatever reason, the payroll system missed it. And then these employees weren't allowed to be eligible or weren't given the chance to join the plan. And that wasn't found for a couple of years. And next thing you know, you've got to calculate gains and losses. And, I helped, clients through the years that had, like, quite frankly, well into the 6-figure corrections that they had to go through because they had internal processes that were issued that created problems and issues that had gone unseen. Mm-hmm. Are you finding the same with, I know that you can get, you get fiduciary liability coverage for breach claims, but things like employee benefits liability insurance, what is it, EBLI? There's EBLI and EPLI, the employer practices liability insurance. Mm-hmm. I would imagine EBLI is what kind of is the coverage that targets, you correct me if I'm wrong, but targets more of those kind of administrative issues that a plan sponsor could have.
Right. Yeah, it does. A fiduciary liability policy depends, but they both would respond potentially to the administrative issues. And I agree. I mean, at downstream, that is really the exposures for the smaller employers out there. Like one claim that came to mind from a fiduciary liability perspective was it was a health benefit administrative hiccup, like mistake, new employee onboarding, they missed the paperwork or whatever to get this employee on. God forbid, 2 weeks later, the employee gets cancer, not on the plan, obviously not able to be put on the plan now because of the mistake. Huge claim paid to the carrier just wrote the claim for the damages. But that's nothing to do with excessive fees, but just your responsibility to be a fiduciary for your participants. So we see that. So that's my argument, or our argument to the underwriters. Let's get to the root of the exposure for the smaller plans. Let's underwrite like we should be, and not think of unrealistic things. But
has that market changed? Like the for like EBLI or EPLI, has that market changed in the same way fiduciary liability?
No, state by statewide. So employment practice liability insurance has certainly changed in California just because of the wage and hour laws, or the ease of filing claims around the wage and hour, questions have exploded that market. But that's an isolated thing. Carriers have got their mind around it in a carrier, because fiduciary is managed by ERISA. It's a national, standard there. There is no, geographic pockets where it gets specific. So it's across the board. Yeah.
Got it.
And these small carriers are just, like I said before, it's not worth it for them they can't charge enough premium to put in their minds, the exposure out there, the limits exposure.
Right. So let's talk about for RIAs, and you mentioned kind of E&O. We definitely saw at when I was at Greenspring, and I kind of was point person for like our coverage and whatnot. And what was interesting was, coverage it didn't seem like tied to our assets per se. It was tied more to our revenue. I don't know if that was correct or not, but we saw our premiums, obviously, as we got bigger, we saw our premiums go up. What are you seeing in kind of the marketplace around E&O, and what should RIAs especially be focused on when they're thinking about the coverage, the third-party coverage that they can get for the professional services they offer?
Yeah, so what we're seeing, you're right. So in E&O, whether you're a financial advisor, a doctor, a lawyer, an architect, that revenues is always the main driver in determining a premium, with the logic being this: you, the professional firm, have charged your fees, you collected this much, and then it's just a measuring stick for how much exposure is out there that you could make a mistake as a professional. And then it drills down from there, like, okay, what are you doing specific areas of practice wise to generate those fees? And then it gets into, are you recommending alternative investments or something a little more exotic than the publicly traded instruments? And it drills down from there. From an underwriting perspective, that's sort of the mathematical tree to get to a premium, basically. So we're seeing rates certainly not go down in the E&O marketplace, but they're not being affected like they are in the first party fiduciary liability world, where we'll see like 4 times, renewals being implemented. We're not seeing that on the E&O side. Cyber liability, different podcast, different conversation.
We'll talk about that a little bit.
Is on par with fiduciary in the craziness, environment. But yeah, the E&O market is steady. We have our arms around it. Things that get the underwriter's attention from an underwriting perspective are the more out of the box, creative type things that private things that aren't registered, things like that don't have that oversight from a regulatory body as an investment instrument anyway, become a little more concerning to an underwriter if they see that application.
Right. One of the things, the affirmative coverage. So, you get RIAs. What's the difference in are there differences between maybe a standard, policy in the RIA community versus for maybe a firm that just does private wealth versus a firm that actually does 401k? So you mentioned it on the beginning of our talk. When we met back in 2008, I was giving a presentation with a couple of colleagues of mine on that very point, because at that point in the marketplace, the E&O policy forms, the carriers, remember there's multiple ones, so there's not one that we can just compare. But generally speaking, what we were seeing at that time was either fiduciary exclusions on an E&O policy, like I don't want to cover a plan advisor. I just want to cover a wealth manager or something like that because I'm petrified of ERISA and the costs that come with that. So in that day, we either saw an exclusion, we either saw silent wording, like vague wording. It wasn't, the policies weren't excluding fiduciary services, but they weren't affirmatively stating that they were covering them in the definition section of professional service. So I like to think that we had a hand in that from that day to this day. The carriers' forms have evolved that, generally speaking, I'm not presenting that topic anymore, meaning that the E&O carriers have caught up with the fiduciary, duty, responsibility, and evolution of DOL defining it and whatnot, that any advisors in a fiduciary capacity, so we have to cover it. And as the brokerage community, we beat the carriers and underwriters up enough that they've just now improved their policy forms to cover fiduciary services as a core offering in the services. So if you're a wealth manager and you have 4 or 5, retirement plans, the same policy can cover all your types of services today, where in 2008, it might have been, you probably had to pay a little bit more attention to that, maybe get an endorsement for fiduciary. Our product that we administer has affirmative language. We have a carve-out endorsement. We define ERISA and
all the relative like voluntary compliance. Like we try to take like a first party fiduciary liability policy and overlay it with an E&O policy, because at the plan advisor perspective, he or she as a plan advisor has the same exposures that their client have, right, at claim time. The compliance, the voluntary things that they need to do to fix the plan. So coordinating the language in the policy to trigger properly was I would say good work over the years that we developed.
Are you seeing any difference when it comes to 321 versus 338? That's the interesting, a lot of RIAs have they pitched the 338 services. As a 321, and I think what you've seen in a lot of these, in some more recent cases, SeaWorld was an example. You're starting to see vendors be named in these lawsuits. So like that SeaWorld case, the advisory firm was named in it. They weren't a defendant, but they were named as part of it. I think what you haven't really seen is it's been kind of the rare case where you've had actually an advisor get named as an actual defendant.
Mm-hmm.
But this whole idea of being a 338, I mean, the pitch is always like, hey, in the event you get sued, we take on that liability. As a 321, you don't have discretion. Does the insurance carrier market kind of understand that? Because as a 321, I would say your risk is pretty minimal because you don't have discretion. As a 338, and my worry always is you've got these RIAs that I know we tried to increase our coverage over the years as our assets grew, and because it was more tied to kind of like our revenue, and a lot of RIAs, I've seen this, have relatively small coverage relative to the assets that they're responsible for. Actually, shockingly low. And if the pitch is like, hey, hire us, we'll be a 338. We take on the discretion and liability here. God forbid, though, that advisor actually gets named as a defendant. And the plan sponsor basically says, hey, not our issue. We hired these folks over here. But if that firm doesn't have claims paying ability, in some ways, I would argue that appointment isn't going to be prudent. If I'm a plan sponsor and I hired and appointed a 338 that didn't have sufficient coverage relative to my plan, but I didn't really know.
That's a breach of fiduciary responsibility, right?
Yeah, at the end of the day, hiring an advisor that doesn't to be a 338 that doesn't have claims paying ability, I would argue kind of makes that appointment potentially invalid. I don't think we've really seen that a whole lot. But do carriers understand? Do they rate 321 versus 338 differently?
Mm-hmm. They do, and it depends on the philosophy of the carriers. I can think of a carrier that, as you pointed out, 321 non-discretion. Okay, that's safer, from an exposure perspective. So I'll credit that, or I'll give a better rating factor for that as opposed to 338 percentage-wise. In our program, and I mentioned earlier, the submission and working with the right professionals and things of that nature. 338. I have our underwriters at London willing to provide credits for the right applicants, meaning if the applicant can demonstrate that they have the specialty designations or have done, coursework or are providing their clients with, I'll say outside of the normal, tools, to help educate their committees and plan sponsors to educate them. So I'll argue with our underwriters that a 338 advisor that is checking all these boxes that we're considering as a prudent professional should be a lower exposure than someone that doesn't have these designations and is saying, hey, here's my advice, committee, do it or not, and maybe they do it, maybe they didn't understand it. So I mean, the answer is it differs from carrier to carrier. The easy answer is 321 is a lower exposure than 338 because of the discretion. But I think that there's a very valid argument to say that 338 shouldn't be more expensive if that professional is truly a professional with the right designations, doing the right things for his or her clients and things of that nature. And I think it could be a benefit to the rate, and as opposed to a negative.
And I would say I've seen this. Just part of the challenge in the advisor world over the past 5 to 7 years is everybody says the same thing now. You go on websites and everybody talks about the same set of services. And, in the same way that just because somebody went to medical school doesn't mean they're a great doctor. Like they may have the credentials after their name, but there's a difference between, just like in any industry, the difference between a great doctor and an average doctor, like that's not a small gap. That's a major gap. And I would say from what I've seen is, and this is a real challenge for plan sponsors because they don't know how to discern this. And I would argue that carriers don't know how to discern this. And it sounds like you're trying to help make carriers smarter. But just because somebody says they specialize or, has lots of plans, like the difference between the work that's actually being delivered, just because somebody says they're a 338, like there's a wide variance in terms of how good advisors actually are. But that's really hard. And plan sponsors, like they don't know how to discern. They don't know what, a good service model is versus a bad service model. They don't know what, really high quality advice is versus very run of the mill advice. They just know that everybody says they do the same things. And maybe that's part of your job. It sounds like educating these carriers is like, look, for this, let's say firm in particular, you have two firms that say they're 338s, but this one in particular, like here's the evidence to kind of demonstrate that they are actually a much better flavor of 338 than this one over here.
For example, this 338 advisor is working with this particular ERISA law firm that nationally is recognized, therefore their client-facing contracts are reviewed. But so things like that, like who is the advisor working with and what is the advisor providing outside of the normal services are the things that underwriters like eat up, they can't hear enough about to get excited to offer good terms and things of that nature. And they're not on applications, those type of questions.
Right. What is, so let's just kind of shift the conversation for a few minutes, because you brought up a good topic earlier. And I think it we've seen obviously this and like our financial institution policy, and I think a lot now, right? There's a heavy focus on cyber security. The DOL has become very active and provided much more specific guidance around cyber. The record keepers in particular, and I know a lot of advisors now through RFPs and due diligence and having conversations around helping plan sponsors really understand the cyber practices of their record keeper, which has a lot of personally identifiable information, or PII. What are you seeing in terms of the cyber market as it relates to both ERISA plans, but RIAs in general? If you think about like a Fidelity or an Empower or a Vanguard or a T. Rowe Price, they're spending tens of millions of dollars on their security protocols and practices. A lot of RIAs that are smaller don't have the same type of IT infrastructure and whatnot. Like, what are you seeing in the cyber world?
Yeah, so I mean, the cyber world is rivaling the fiduciary marketplace as a hard to place, supply type issue. Again, it was very commonplace to have a lot of different carriers, and then all these breach claims, ransomware claims, fraudulent instruction claims are all, even more highlighted since COVID. The work from home, type experience just got all these fraudsters real excited, to penetrate, to take advantage, of the U.S. companies, and so I mean, claims are outside. So I mean, so the point I'll make about from an RIA, the real life cyber liability exposure isn't the data breach that Target saw, like, or Home Depot, or what have you. It's the ransomware claim that's going to hijack your system. This is happening. Um, that will shut everything down and ask you for a payment of $325,000, and we'll give you your systems back. And this is literally happening on a daily basis. These ransom claims. So that's a real prevalent, and plan advisors have access to large balances, participant balances. So they're like the second largest target from these fraudsters to go after, not just investment advisors, plan advisors. So we're seeing, they're definitely under the microscope. So yeah, the cyber liability exposure that an RIA listening to this needs to have fraudulent instruction coverage built into their policy. It's not just, I have cyber, then it must be covered. It's a specific thing that you need to look at, and then ransomware coverage. And then, of course, client notification coverage. God forbid you had a breach and you needed to notify all your clients and things of that. That's pretty commonplace on all cyber forms, but the fraud and the ransom is not a commonplace thing. It's either sublimited, excluded, similar to what we're talking about fiduciary on the E&O side back in the day. It's a complex buy right now for a financial institution. And I'd argue the smaller, the less sophisticated firm is more exposed, right? You don't have those resources and those vendors to hire, basically, to insulate your system. So
Yeah, it's interesting. I think the big custodians on our RA side are getting much more stringent about, I think I just saw that Schwab requires, I think, at least $1 million in cyber
and
coverage.
social engineering coverage.
Social engineering.
Yeah.
We actually, at my old firm, we actually ran into some of those issues, and our ops person and who helped with compliance actually did a phenomenal job. There was a client at one point, we got an email from them, and I think they were like an interior decorator. And the email basically was like, hey, I'm with a client right now. We're decorating their place. I need to buy furniture for them. Can you send me, $15,000 out of my account?
Mm-hmm.
And kudos to our ops person. She emailed back and said, hey, not a problem, but kind of our policy is we need kind of verbal confirmation. Call me at this number and we'll get the process taken care of. Didn't hear anything from. Email comes a little bit later, I need this money. And it was a series of over 8 hours of 3 or 4 emails that got increasingly angry. And she was trying to reach out to the client, couldn't get the client, ultimately got the client on the phone. And the client's like, I have no idea what you're talking about. But what was fascinating was, and we reached out to the police and, kind of on their behalf, and got account numbers changed and all these different things. But the social engineering aspect, whoever had hacked their email account clearly had gone through and read and kind of understood, probably read their emails, understood they were an interior, came up with this narrative that sounded on the face like it was literally the person. And we had a couple of incidents of that both were thwarted, but it was scary when you started to see, and this was a few years back, so I can only imagine it's getting even worse.
Well, yeah, it is, and what the carriers are doing, and this is important for folks to hear, is that they're actually putting stipulations in the policy form that your ops person did a great job. If there's no verbal communication, phone calls or what have you, to confirm the identity of this person, even if you had cyber liability insurance with fraudulent instruction coverage, and if you're in your case, your ops person released that money, didn't make a phone call, there would be no coverage for that, even though you had. So that is something that everybody needs to hear. I mean, that is the number one cyber exposure for an RIA is this fraud, these fraudulent false pretense. That they have a whole host of names out there, but it all starts with social engineering, that phishing to get into your system and phishing email, and then God knows how these fraudsters can work from there. So
right. I think what you said was that, and this is the scary thing, right, about insurance is you can think you have coverage, but if you, as let's say an RIA, haven't read I think about it like with a plan sponsor, right? Very few sponsors actually read their plan document. They have a document or an IPS, right? They get one and they don't really know what it says or kind of what's required. I think a lot of RIAs, would you say is fair that just because you have coverage doesn't necessarily mean you can sleep well at night if you don't actually know. You could think you have cyber coverage, but to your point, if you don't know that if you don't do the verbal, let's say, that, even if you had coverage, it's not going to pay. What's your advice? What's your recommendation for RIAs to really understand their policies and actually what the steps they need to take in the event of an incident so that they can have confidence that they didn't waste premiums on insurance that wasn't going to pay out because they didn't keep up their end of the bargain that was required within the policy?
Yeah, that's a really good point, and it's something that keeps me up at night, literally from my team's exposure, communicating that to the clients, because as I said, I mean, cyber liability is very prevalent. We're selling hundreds of cyber liability policies to RIAs on a weekly basis. So my biggest concern and consistent message to the team is make sure that everybody buying this understands exactly that provision in the agreement. So I guess my short answer to what would the advice be? It's sort of similar to what I said in the fiduciary world at the plan sponsor level. Like, you need to hire a fiduciary professional to help you understand this. I think that same logic applies in the insurance world. It'd be nice to buy your insurance from your buddy that you play golf with, and you buy your auto and home and, umbrella policies, personal line stuff. But if he or she doesn't specialize in these type of specialty products, it's probably not the time to give the business there. So I would say just do a little more due diligence with who you're working with, and their capabilities.
And what's the typical process that you follow? So let's say, I'm an RIA and I listen to this podcast and I say, what, Tom really knows, it's stuff, and he's having, right. That's the power of specialization is, you have more meaningful conversations with the specialist because they know where kind of the bodies are buried. Like what is the process that you will typically take? Like, how does it work with an RIA? Say they listen, they say, you know what, I probably should review my coverage, or, potentially, work with Tom or with Lockton. Like what's the process that they need to go through or that you take them through?
Yeah, the process that I coach and we implement, is a more educational approach. So I like to start every conversation with a new relationship with, can I review everything that you have, and come back to you with an assessment of where it is, explain it to you. A lot of times when we go through that example, we might even had that example, you and I, back in the day, where you're like, oh, okay, this, that, and the other, like where the client or the prospect in this case would be learning about what they have or don't have, in the process. So to me, we're not selling anything. We're just educating our clients on what they need and what they should be thinking about and how to get it. We obviously can help them, obtain that with our relationships and our underwriting, carrier contracts and things of that nature. But I think that the process starts with a complimentary review of what you have. I'm talking coverage. I'm talking limits. Dig into the type of work, 338 versus 321. You have some large plans that you work like. So just really think about, do I have the right limit of liability for my profile at my RIA? Just because I'm a quote unquote small to mid-size RIA doesn't mean $1 million limit is sufficient. If you have lots, a handful of large plans, you might have a different exposure than someone in your revenue profile, might have. So, I mean, there's way more to it than just buying a policy. As we talked about 3 different policies, right? And now cyber liability policy, putting requirements in to actually trigger the coverage that you're buying. You need to do this, this, and this. I mean, that's not on the proposal that you're signing when you're accepting it. That's in the fine print. And so I think that just work with credible specialists, in this day and age.
No, I think that's great. This feedback is crushing me right now. that I keep hearing. Hopefully, we can take care of that in post production. But this has been, I think, a super interesting conversation, Tom. I think it's a very, very timely topic. One of the things that because a lot of advisors listen to this, I would say that I think now is the time. I have one of my best friends actually is and former clients has a P&C brokerage firm, and he always used to say that the best way to test whether or not your homeowner's insurance is going to pay out isn't to burn your house down. So that kind of his philosophy was like, you want to make sure that you're taking the steps before a claim happens, because it's a lot harder, once an incident happens you want to be prepared ahead of time, not after the fact. It's kind of like your taxes, right? You like the time to make tax or to implement tax strategies is before December 31st, not, after 31st.
Oh, I should have.
And so, I think this is a really timely topic. And, part of the value add for advisors, not only is making sure that they've got the right coverage in place, but I think also this is one of the things that separate as being a good partner to their clients. If clients are having issues accessing the insurance markets, finding a specialist to even be able to help clients, there's a tremendous amount of value add when you can help a client work through a really kind of difficult or sticky issue that may not be related to the work you do directly, but being able to help get them connected with the right folks. I know that plan that I had worked with on that kind of one-off consulting basis. It just kind of came up in conversation. We were going to dinner one night and they were talking about fiduciary coverage. And I'm like, you know what? I got a guy you should talk to. I'm sure he'd have a conversation with you. He specializes, the market's changing. And I know that they were really, really appreciative for that and whatnot. So one of the things with this podcast is my goal is to really make ERISA fiduciary smarter. And so one of the questions I ask typically at the end of each episode is, as it relates to where you specialize, what's the single best piece of advice that you can offer to advisors from a fiduciary perspective as it relates to what you do?
I would say, take the time to truly understand not just your process, your procedures. I think that most RIAs have a fundamental, at least the ones that we work with, of a fundamental process, and they believe in it and they work on that. So I think that that's handled. But from our perspective, I think the assumption of I have the coverage, I'm good, I'm going to not read it and put it in a file and hope to God I never have to realize whether my house burns down or not, that it's going to be covered or not. So I think just take the head out of the sand and take the extra 15 minutes to ask the right questions or the extra questions to the professionals that you're working with from an insurance perspective. Test them. What if we had a cyber breach? If my partner lost his laptop in the airport on his way back, what would you do for me? Just challenge the professionals that you've hired to actually be proactive, like you talked about. And, in the tax scenario, like know what the issue, how you're going to face the issue before it actually happens.
No, I think
being a shortstop, where am I going with this ball before it's hit to me? If it's hit to me, I know I'm going to second, then first, right? Like, so you need to know exactly what you're going to do before it happens.
No, I think that's really good advice. I know that you guys have a bunch of resources at Lockton, and I will link to those in the show notes. And I don't know if you have anything just based on kind of what you just said. Like, a lot of times, I think about like RFPs with plan sponsors. Advisors typically, the RFP, there's like a couple of RFP templates that are out there. And so, I know for us, we tended to see pretty much the same RFP or every RFP we got that we responded to had, 95% of the questions were like literally the exact same questions that we had seen. The challenge for plan sponsor or that we ran into was that just because plan sponsors were asking the right questions, they actually didn't know how to interpret the answer.
Yeah.
So it's not enough to ask the right questions. You actually have to know at a deeper level how to interpret the answers that you're getting. And I would say that I'm not sure many advisors, like I know for myself, like, what you just said about like, ask your current, your current insurance broker, test them out. What if this, what if that happens? To be honest with you, I didn't even know the question. Like, I wouldn't even know the questions to ask. Do you guys have any tools or resources from that perspective? I might have just given you a really good prospect.
You might have seen the light bulb over my head. I don't think we have anything like that, but that would be definitely a quality piece. Like arm our clients or prospects or professionals with the right questions to ask. I think that
and how to interpret not just the questions, but then
what are we looking for here? Right.
Exactly.
Yeah, exactly. That's definitely more important. But I think, Schwab, you brought Schwab up as a custodian, and I think that they're doing a really good job of 3 months putting these highlighting social engineering and things of that, putting these requirements out there for all these fee only advisors. So, I mean, it starts at the education, stage. That Schwab announcement has just generated so much healthy, intelligent conversations with our existing clients to help us further inform our clients on the things that they may not have been worried about. Now they're a little bit more worried about. So.
Well, I just gave you a prospecting tool idea, so that's
Thanks, buddy.
That's free of charge, man. Where can people go to stay connected with you and with what Lockton Affinity is working on? What's the best way for people to connect?
Yeah, so our RIA product, we have a dedicated website. So that's LocktonAffinityAdvisor.com, ADVISOR.com. You can certainly hit me up on LinkedIn. And my email address is my last name Schrandt, SCHRANDT @LocktonAffinity.com. Would love to schedule a break off conversation with anyone that has any additional questions, and be available.
Awesome. Well, Tom, thank you so much. I just on a personal level, in growing our firm over the years, you were a really, really important partner for me and for our firm. So I appreciate that very much. And I think this was great dialogue. Really interesting. We live in interesting times right now as it relates to fiduciary liability and the insurance and coverage and whatnot. And so I just appreciate you coming on the show and providing your insights. And I think listeners will get a lot from it. So thank you so much.
Thank you, Josh. It was fun.